Welcome to this month's Market Insight, where we update you on the latest market developments and share the factors shaping the investment landscape. I'm Sarika Dhanjal, Head of Asset Management at Progeny, and I'm joined today by Ian Hooper, Chief Investment Officer. Ian, as we began the last quarter of 2025, how did markets shape up and what were the key drivers behind their performance?
So financial markets have had a mixed start to the last quarter of the year. Developed equity markets increased by 2.8%, and we saw bonds fall by 0.3%. The gains in growth assets were driven by yet another set of US corporate earnings, which were very strong over Q3. And importantly, we'll come on to this today, signs of easing trade tension between the US and China.
That sets the scene really well, thank you. So, given the mix of positive signals and uncertainties, what's shaping investor sentiment right now?
Okay, that's a good question. So in the short term, we've got ample liquidity in markets. We've got the prospect of the Federal Reserve or the Fed cutting rates. And again, I'm sure we'll talk about that today. And we had positive Q3 earnings growth. So that's really sort of offset some of those market worries we've seen throughout the year. And AI, and we've talked about AI a lot this year, remains a key driver. And companies would have been rewarded for sales and capital investment rather than profits at the moment. And we saw that play out over the last month.
So it makes you wonder then how long this momentum can last. So stepping back from market movements for a moment, what's the standout economic story of the month?
So starting with the economic picture. So the key headline over the month was that crucial late month progress talks between the US and China. US and China have been facing off against each other most of the year since we've had these tariffs implemented by the US. So what does it mean? Well, on the one side, what we're going to see is probably a 1-year deal. It's not signed yet, and there's not wet ink, where we get a pause in steeper US tariffs. But at the same time, we'll limit China's export controls on rare earth minerals. Now, they're crucial constituent of the AI supply chain. So this was positive news for markets, and that's why we saw a rally at the end of the month.
So looking beyond the trade story then, so how are economists viewing the outlook for the global growth?
Economists were quite pessimistic at the start of this year about global growth, particularly once the tariff news was announced. But what we've seen is the International Monetary Fund, the IMF, they now expect global growth of 3.2% for this year, and then slightly lower, 3.1% for next year. So cutting through that, the world economy has recovered from that tariff shock, and we're back onto some reasonable growth rates on a global level.
And what about the UK? So how is its growth outlook shaping up, especially given the pressure on consumers?
So unfortunately, not quite as optimistic a story for UK growth. So we're expecting growth for the next 2 years between 1 and 1.25% GDP growth. Why? Well, consumer spending is still under pressure. We've got a squeeze on real incomes, unemployment, and that's why we're sort of a consumer-led economy. We're not getting the same level of growth that we're seeing on a global scale.
Excellent. So looking then at the US, Ian, so how has the inflation picture evolved recently, and what's the current state of play there?
Okay, so we've talked a lot this year, haven't we, about inflation and inflation risk. And interestingly, we've started to see a surprise on the downside of inflation. So inflation starting to possibly subside from where we thought it would be. Why did we think inflation was going to increase? Well, it was all tariff related. And we've seen some impact of that, but it's been more moderate than we expected. And we've actually seen a softer inflation backdrop. And for that reason, the Federal Reserve, the US Central Bank, decided to actually cut interest rates by 0.25%. So they have a target range, and it's now sat between 3.75 to 4%.
That gives us a lot to think about. So stepping outside the US then, how has the major central banks positioned their monetary policy?
Okay, so I would say the central banks have also probably sat on their hands at the moment. If we look at the ECB, the European Central Bank, we're looking at the UK, we're looking at China. At the moment, they're not really. They're looking at the data before making a decision. The ECB is really about, and this has been a battle for them this year, balancing growth and inflation challenges. China is really about the more of an internal focus, I think, around interest rates and helping real estate and consumers. And there's an anticipation we might see some interest rate action in China eventually to support those areas.
So turning to the UK then, budget is all set for November 26th. How are the concerns influencing investors' expectations?
So yeah, looking ahead, the market in the UK is going to be laser focused on Rachel Reeves standing up on the 26th and talking about the budget. And there's a lot of anticipation in the media, and we talk a lot. We shouldn't get drawn into the media and the noise, so let's not try and do that. But if we look at just some of the numbers and we look at where the UK is, so UK has got some of the highest yields in the G7, so it costs the government more to borrow money in the market. There's talk in the markets that there's a need to raise tax somewhere in the region of 20 to 30 billion pounds.
Certainly sounds like quite a critical moment for the UK. So shifting to the global picture then, growth assets have continued to climb. What's driving that?
I think we've touched on it earlier on. Obviously, we've had some good third quarter earnings. A lot of it is driven by, of course, the AI story. But obviously now we're seeing interest rates maybe falling back into this year, into next year in some economies. That's also positive for growth assets or equities. Okay, so why have growth assets had a good period? Well, we've already touched on that somewhat today. We've seen really solid third quarter numbers, particularly in the US. We've got that AI story and AI spending, and that's driving equity markets forward as well. And we're also now thinking about interest rates maybe falling in some economies as we go into 2026. So they're sort of the high level reasons why we're seeing growth assets move forward. If we just look regionally over the month, it was actually Japan that led performance. That was due to the country got its first female prime minister, and she's going to pursue this expansionary fiscal and monetary policy, which was from a previous administration as well. And this was viewed positively by markets over the month.
So it's really exciting to see, what this could mean for the future of Japan. So moving then to the US, what's been driving the latest stock market rally?
Okay, so the latest rally in US markets have been helped by buoyant company profits. If we just look at what happened at the end of the month, so we had 320 companies announce their results, which was over 70% of market capitalizations, and 82% of them beat market consensus forecasts. So we've just had some really sort of stellar results again in the US, and that has been driving US markets forward.
Thanks, Ian. So looking at regional performance then, how have the recent trade developments and market dynamics shaped the returns for the UK?
So if we look at the UK market, there was an increase of 3.7% in the wider UK market because we saw falling gilt yields, which we'll touch on the sort of bond defensive asset section. And that started to benefit sectors that are interest rate sensitive and domestically focused. We also saw stronger commodities, and that helped the UK mining sector, a big part of one of the main indices in the UK market, and also a weaker sterling, and that a number of our companies, of course, make their profits outside of the UK, and it helped overseas earners. So overall, it was a good month for UK PLC.
So it feels like there's a lot for our investors to consider right now. So how did the backdrop play out in terms of style performance?
Okay, so unsurprisingly, it was growth stocks. So it was the growth factor that performed well over the month, outperforming value stocks. And of course, it's all driven by this enthusiasm for AI underpinned those returns over the month.
So given the regional outperformance we've seen, how are defensive assets holding up, particularly in markets facing political or fiscal pressure?
Turning to defensive assets. So What do I mean by that? We talk things like bonds, for example, the type of investments that can be uncorrelated with growth assets or equities. So when markets fall, bonds are seen as a safer haven, and we've talked about that in some of these sessions before. And if you look at the UK and France, for example, in the G7, they've got high yields. It costs those governments more to borrow money because of the political and sort of fiscal uncertainties of those countries. And it was interesting that we've just seen two businesses in the US, First Brand and Tricolor. There was actually those bonds were bust over the period, and it's just a reminder. Even when we're getting a growth in our economy, there's still credit risk, and this is where we shouldn't be complacent when markets are doing really well. And as we know, we're investing for the long term, but there's always risk to investing in markets, whether it be defensive assets or growth assets.
So amid those concerns, you mentioned earlier about the Bank of England, how they're holding rates. How does that impact UK gilts?
Okay, so UK gilts were actually the standout performer over the month. If you look at the 10-year yield, UK Treasury, it fell by 0.3%. Why? Well, there was a dovish shift from the Bank of England Governor Andrew Bailey. So what do we mean by that? There's suddenly this perception that rates are going to start to fall. Why? Well, weaker inflation data, a more cautious tone on growth. What the market took that as a signal was that we're going to get a decrease in interest rates as we go into 2026. In fact, financial markets are now pricing in reductions of 0.6% as we go into, or by the end of, shall I say, 2026.
Oh, thanks, Ian. So as we wrap up, how would you characterise the overall market tone in October, and what was the outlook from here?
So in summary, October was a broadly positive month. There was a renewed optimism about US equity markets, but also that saw an increase in US equity market valuations, driven by, of course, the AI story and the technology story. And I think on balance, this leaves very little margin for error with US markets and US valuations right now. So from our perspective, we're keeping portfolios well diversified. And we've talked a lot about that this year. So not too heavily reliant on the US. We're adding exposure to areas where we see more balanced outlook, balancing risk and reward. And bear in mind, as we talked about risk earlier and credit risk, keep protection in your portfolios because inflation may come back. We haven't seen the level we thought, but we might get inflation back in the system on the back of US tariffs. That US tariff story has not ended. So in summary, stay with diversification, keep with a wide basket of assets. Despite equity markets doing well, they are on some US markets, particularly on some quite high valuations, and any error we may see a pullback in markets.
So that wraps up this month's Market Insight. As always, we'll continue to monitor the data and key trends as they unfold. Thank you for watching, and we'll see you in the next episode.